Good morning, everybody. Happy Friday to each and every one of you. It is time to get back to the charts on a Friday morning. What a wild week. To summarize, we started this week with the markets in crash mode. Right now, we're ending well off of those lows, but actually starting to see a little bit of weakness in the markets. Very minor at this point in time, but I want to kind of game out what in general I would expect today. So let's get right into the charts here on this Friday morning from verifiedinvesting.com. And what we can see here is that this is the S&P or the Spiders pre-market. And essentially what I always like to do is show you guys where we closed yesterday, right here. All right. And this was after hours up till 8 o'clock. Remember, the after hours data closes down at 8 o'clock and then it reopens at 4 in the morning. And that's what we had here. So we went up a little initially and then have started to slowly fade. Net, if we look at where we closed yesterday to where we currently are, we're fractionally negative. Now, if you're looking at human psychology, let's talk some human psychology here. What is the likely scenario? So my guess is you're going to see some chop, maybe even a little bit of upside early in the day. And then think about this. What happened to people that went long into the weekend last Friday? Right. So last Friday seemed everything was okay. Markets were, they were a little bit weaker, but nonetheless, everything was okay. And they woke up on Monday morning to a bloodbath. And that psychologically is going to have an impact on investors, right? And so what my guess is what you'll see towards the end of today, you'll see kind of profit taking coming in, or at least investors inching or moving to the sidelines for a little bit of downside in the market. So most likely, again, if I had to game this out and say, again, choppy sideways, maybe a little up action early the first half of the day, and then a little bit of a fade in the second half of the day. Now, do I expect today to be a down 2% day on Wall Street? No. I think, again, somewhere between 0 and 1% would be more likely about where we end on this Friday. But I hope you guys kind of understand the psychology of that. It's very important to kind of start understanding how investors react in normal scenarios. And you do so by looking at history, right? So if we go to the daily chart here, this was where we ended on Friday, which was down, but again, it wasn't like, holy cow, we're collapsing. And then look, on Monday where we opened all the way down here. NASDAQ was down as much as 6.4%, I believe, pre-market before we snapped back. So there's this little bit of I touched the hot stove type scenario where going into the weekend, you may see a little bit of a fade. Some investors saying, you know what, I don't want to be in these positions for 2 days where the markets are closed. Who knows what happens in the Middle East? Who knows what happens, with Japan and all these other scenarios. All right, speaking of Japan, I do want to touch base on this because I think this has to be reinforced to us as investors, right? So really do think that this is very, very important to take note of. All right. So what do I mean by this? Well, we can see clearly that the Nikkei is pretty quiet here. It was up a little bit last night. We were up about 0.5%. But what I'm drawing my attention to here, guys, is how bad this is what the Bank of Japan did. So if we look at the Nikkei and let's flip back to the charts, what really happened? So the Nikkei did have a big tumble. There's no doubt about it, right? If we take a measurement tool and we drag it from here down to this low, the Nikkei was down about 26%. Now, it's a pretty big drop in a stock market for about 1 month period. But if we zoom out, we see that the Nikkei is still, even at that level, the Nikkei was still up 100% since March 2020. And if we go to 2024, the Nikkei basically went back to the flat line, meaning that the gains for the year were wiped out. All right, that's all that happened. Basically, from January 1st, in this dump, the Nikkei wiped out its year to date gains. Yet, what did the Bank of Japan do? The Bank of Japan came in and bowed to the markets and said, you know what? We don't want everyone to feel this pain. So we are going to say that we will stop our monetary policy, our hiking of rates based on 40 years of lenient policy that really screwed things up. We're not going to undo it because we worry that this is too bad of a scenario. And again, my stressing point to you guys is that when you have a central bank that can be essentially pushed to do something by the equity markets, it sets an unbelievably bad precedent, and it tells you that the markets now have control. The best analogy to make here is that essentially you have a child that misbehaves and they got rewarded for it. And what does the child do next time? They say, hey, listen, it worked last time. Let me throw a tantrum and I'll get my way. And that is not good. Okay. It's more important in the long term. Now, listen, it's just like a drug addict. Yeah, it's great to get your fix. Let's get the fix. Everything's okay. We'll get our drug, but does the patient eventually die because you have overdoses or because eventually that drug kills them? The answer is yes. And that is ultimately the game plan here of what unfortunately will befall the markets. And this is something that the Federal Reserve, all of the central banks are doing, guys. They always bow to the will of the markets. All right. And again, it is not good. All right. My sermon is done for the day. I just had to make that point because it is a point that I stress to you guys. And it's not something that in the short term matters, right? I mean, well, it matters, but it's not that in the short term it's going to have implications. I am talking about the 3 to 5 to 10-year plan here that eventually this will cause an epic collapse in the markets where we will see the equity markets down 75%. It will be a, you know, not just a great recession. It'll be far worse than a great recession. I'm always hesitant to say depression because of how bad the Great Depression was, but you can't have this as a sustainable monetary policy where you bow every time to the markets. All right. In any case, going back to the charts, guys, I did want to touch base on the 10-year yield. So the 10-year yield did have a bounce this week. Notice how it's coming in a little bit today, and the markets are starting to fade today, right? So what does that tell us? It tells us the markets are actually skittish about yields going down. Remember 6 months ago when the markets would rally every time the yield on the 10-year downticked? Well, now it is the opposite because down yields, and I said this back 6 months ago, eventually yields going down would be bad because it tells you that the economy is getting weaker. All right. And again, before it was, oh, the economy will stay strong because, and the Federal Reserve will still cut rates. So going down is okay on the 10-year yield. Not anymore. Notice the recent bounce in the yields has coincided with the recent bounce in stocks. Now we're starting to see weakness. The markets are beginning to roll over this morning a little bit. And again, I say little, it's only a little downtick here. All right, now the bigger picture here is if we go to our weekly chart, what do we see on this? We see that we have broken this upsloping channel on the 10-year yield. My target zone for the 10-year yield is down here. So if we take a trend line and we connect it to the 2020 lows through these lows right here, it goes perfectly, lines up perfectly to those lows. This line again meets or is getting close to meeting this pivot high, these lows here. And so what you can do here is you can extrapolate that a general target on the 10-year is going to be around 330 to about 320. That would be where the 10-year yield should find its next big level of support. Speaking of support, we have the US dollar, which broke support on the weekly chart, pivot low, pivot low, pivot low. I talked about this earlier this week or last week when it broke. It did get a little bounce off of the lows this week, but if we go to the daily chart, what type of pattern formation is this, right? What type of pattern is this forming? And what we know is a down move with inside bar consolidation. That's bearish consolidation. Maybe it retraces to the scene of the crime. We'll have to see. But ultimately, the dollar should head lower based on this. So again, not only has the dollar broken technical support, but it is now bear flagging or in spirit of bear flagging, and thus should see further downside as well. All right. So again, lots of signals about a weakening U.S. economy. The other thing I just like to point out to you guys is that yesterday we saw that non-farm, not the non-farm, I was going to say non-farm payrolls, but no, it wasn't even that significant. Yesterday we got the jobless claims numbers. It came in 7,000 better than expected. Historically, that number and that beat has never moved the markets. Never, ever, ever. All right. What that told me is that number one, be cautious because again, the markets were looking for a reason, right? It's almost like, oh man, if I'd only get a sign that something is about to change in my life, right? Here, you guys know I'm a huge analogy person, and just at that moment, a bird flies over your head, and you're like, oh look, there's a bird. That's the sign. Oh, okay, rally, right? It was almost like that, and so the markets were looking for a reason to rally, and ultimately they took that as the signal of why they should rally. I would say be cautious on that. It is not a good reason. It's not like, oh my goodness, this is fundamentally secure. It was a jobless claim weekly number, and it came in slightly, I stress slightly better than expected. And the markets ripped higher yesterday. So again, I still think if we go back to the spiders chart here, let's go back to the S&P 500 chart here. I still think that we could be in store. In fact, let me go to the spider SPY. I have my lines on this. So here's your spiders chart, right? Your SPY chart. I still think there's a chance we could go up here. There's a gap fill. This is kind of my max upside target on this bounce. So there still could be next week some upside. And I think if Monday, and I think this is, we gamed out what could happen today, but let's extrapolate it out to Monday. So if Monday nothing has happened and the Nikkei is still relaxing and chilling and maybe rallying a little bit, then US markets should get a bid next week again. And then I think what we see is an upside move here to this target zone right here, maybe up and touch this line, but that would then yield our next leg to the downside. That in general is how technical analysis should play out on the charts here. All right. So just a couple key things on that front there. Again, just noticing that if everything is calm come Monday, look for further upside in the markets. I think stocks like Micron still should have some further upside off of key levels here. I could see Micron back to about 101 to 102 before it runs into resistance there. There's a gap fill on the chart as well. Nvidia, I could see back above 110 briefly before that next leg of selling comes in. All right, so that's just a little summary on that front. I did want to just take a quick note and just say to you guys that don't forget, make sure that data center becomes part of your daily routine to check out the heat map on our homepage. And again, folks, as always, I can put this up here, but verifiedinvesting.com homepage has the data center. It is free, an ever-growing portfolio of data technical analysis that is key to every trader and investor. So make sure you check that out. There's articles I'm writing with TA every day. The other pros are as well. Heat maps, earnings calendar, economic calendar, all of the other data points as well. The Fed rate hike tool and rate cut tool is there as well. All right. Okay, couple other things. What I want to do here is now get into some of these other ones. I got to take a look at natural gas. Natural gas continues to inch up a little bit here. What a breakout on this continuing here. Resistance, the big test today is going to be this high pivot. Now, one of the things I was just talking to members about of smart money stocks and smart money commodities was what is the possibility that if we stall at this high and pull back, could we potentially be creating what's called an inverse head and shoulder pattern, which is a bullish pattern? All right. Now, again, it's not created yet, but what we can see here is if we come up here and let's say we do get a pullback, which you should get, we then could have again an inverse head and shoulders, which is a bullish pattern formation. So essentially, how I'm gaming this is that if we get a pullback either at this 228, 230 level or below, and we pull back, let's say to 205 on natural gas, I'll be looking to inch in again. $2 to 205 would be perfect for that next leg up and then the breakout. And I've shown you guys this before, but if that did happen, you can actually do a measured move and find out the distance of that breakout to target. What you do is you take the low of the head and you shoot a line straight up to the neckline. This is called the neckline right here of the inverse head and shoulders. And you take that distance right there. So it's about an 18% move, but it's more important that it's 35 cents. And you take that and wherever it breaks out, so you have to watch for where it breaks above the neckline. You do that measurement, and that would be then your target upside, which here it looks like around 260, 255, which interestingly enough is right here in that midpoint, which I told you guys would be your max upside level on natural gas. All right. So again, just something to keep an eye on there. And I'm obviously, part of the game plan is to game these things out. in terms of, all right, let's look at what's going on in the charts, right? Let's look at what's going on in the charts right now, but let's also plan it out like 3 chess moves ahead and see what could happen. If this happens and then this happens, what would be the ultimate target on these things? And obviously, I'll update you guys like I always do in these game plans as things occur. Okay, let's go to Bitcoin. Bitcoin had a rock star move here to the upside yesterday. That was awesome. Now, remember, I had given you guys the 60,000 level of resistance. We got above it. So that's good. But there's a caveat. There's always a caveat, right? So you closed above it. That's step number one in bullishness taking back over. But it's only step number one. Why? Well, what you have to understand is if you've taken the winning trader series and you know this, and by the way, so many of you took advantage of that sale. And by the way, I don't think I mentioned this, but I did a lot of soul searching, and you know, the price went up, but I didn't want to raise it back to the 10K mark. I don't think that's sustainable for retail investors. And I understand for a lot of you guys, even at 449.97 or whatever it's at, it's still unsustainable, but at least it's somewhat manageable for the life-changing information in there. But the point is, we raised it, but I won't put it back to that 10K mark. That's unsustainable for so many people out there. Okay, so just wanted to make that point. And I still understand it's very expensive. Don't get me wrong. I understand that. But for those of you that have taken it, that employ it, that study it, it will change your life. There's no doubt about it. Okay. Anyways, going back to this, speaking of the winning trader series, what we see here is that we closed below the 60K level. We confirmed. What that means is that you must reconfirm above 60,000. So we closed above it, which is step number one, but it now needs to confirm. If it doesn't confirm and it closes back below, that's a failed move above, and it could go back down. So it's right on this 60,000 level. If you want something to follow today, follow a daily close on Bitcoin. Where does it close? Above or below 60,000? If it closes above, it doesn't mean it confirms. It has to close above yesterday's high to confirm. Okay, but at least it would still be open to confirming. Closes back below, it can't confirm. It would have to close back above and then start the whole process again. What I always say to traders, what happens below, so if it confirms below, it must confirm above. If it just closes below, it only needs to close above. So what happens below must happen above, etc. Okay, so we're watching Bitcoin very, very closely. Ethereum had an awesome move up yesterday afternoon. The altcoins took off. In smart money crypto, we took 3 more winners off the table, just crushing that on the buy. We bought on the dip and obviously taking profits on the way up. In terms of resistance, 2,800 to 3,000 is your resistance zone. So we still should have a little bit more upside in that. All right. Looking at gold real quickly here, guys. Gold is inching up a little bit. Gold closed above this midpoint yesterday. I talked about that as a key thing to watch. That is good. What that tells us is that bullishness remains intact on gold, and it could head up to 2,500. Now, 2,500 is going to be a big level of resistance. So a lot of people, what I've kind of gamed out is that if gold gets to 2,500, the media is going to go nuts over it. It's going to create this uber bullish sentiment. And then honestly, I think that's where it pulls back at that point. Okay. So again, watch that really carefully, is that if it gets to that point, you're going to get kind of FOMO in gold from retail. Don't get lured in by that. Wait for a pullback. You'll get a pullback where you should get a pullback to buy gold. And again, this is always how it works. When the NASDAQ, when the S&P make new all-time highs at key even numbers, CNBC, Bloomberg, they get the pom-poms out. They pump it. They're like, yay, they get all the, the big headlines at the bottom of the screen on every media outlet, new all-time high above 50K, whatever it is. And what that does is it triggers an emotional response. And this is the psychology of the market that's so important for investors to get, is it triggers that emotional response within investors to go long at those highs. Never go long at all-time highs, guys. Never go long at all-time highs. Wait for a pullback. Inevitably, you get one. And again, so oftentimes once you lure in those investors that are getting coaxed in by mainstream media or the social media hype, that's where it is. Like, think about Bitcoin back in 2021 when it took out 65,000. Yeah, it went up to 69, but it was that the pumping of, oh my goodness, on social media that lured in all these people that had been on the sidelines at the highs. And then what does it do? It goes down to 15,000. And I'm not saying every market goes down like that. It just, that happened to be what happened to Bitcoin. But at least there's usually a pullback. And so, as bullish as I am on gold, right? I'm hugely bullish on gold over the longer term macro scenario. I still wouldn't say, hey, buy at 2,500 when it pierces 2,500. Instead, you usually get the even number pierce, a retrace, and then you buy on the retrace. By the way, is it possible you missed the trade? Heck yeah. I missed so many trades in my life. But you know what? Doesn't matter because there's always another trade to catch. Right? Just always another trade. And people get so wrapped up in, oh my goodness, I might miss a trade, that they end up taking trades they shouldn't get or shouldn't take, and then they get themselves in trouble. And I still get myself in trouble in trades. It's just that's the natural part of being human. But and by the way, charts just don't always pan out. They're probability based, right? So even at 70% win rate or 80% win rate, 2 to 3 trades won't work out every 10. That's the standard way it goes. All right. In any case, I did want to show a couple charts here real quick. We'll go over silver in a second, but I just want to show this Amazon chart. It's just another example of how powerful channels are. So we talk about channels, and look at this perfectly parallel line. And it literally gave us the low on Amazon before this recent bounce. Just so cool to see this type of stuff play out. And I encourage you, I know you don't hear about parallels very often. In fact, I might be the only one talking about it aside from the other traders here at Verified Investing, because we all get together and share our knowledge. But parallels are impressively accurate. The only thing you have to know is that parallels, upsloping parallels, eventually break to the downside. So generally, 1, 2, 3, 4, I would say by 5, it favors a breakdown. What this tells me is that the next time down, you might actually break to the downside. And that kind of matches what I'm thinking with the market. So it's a parallel works, but the more times it hits, the weaker that line becomes. And again, upsloping parallels generally break to the downside. Downsloping parallels generally break to the upside. All right, quickly going to silver's chart. Let's take a look at silver real quick. And silver, again, you can see it got rejected at this little bit of resistance right here. It's basically flat on the day. Doesn't mean it can't go through, but even if it does, there's more resistance right in this range to monitor there as well. And then if we look at oil is pushing up, but it is kissing resistance as well, down-sloping trend line. And again, oil could get through this level. These down-sloping trend lines that are so steep can easily be broken to the upside, but there will be a point if it keeps going up where I short oil again. There's no doubt about it. Oil, again, the bigger macro play, as I've said many times to you guys, still remains to the downside. All right. Let me see if there's anything else. Let's look at copper real quickly, just because, again, I did palladium yesterday and platinum, so what the heck, we'll throw copper in there. Notice where copper bounced, guys. I love this. Notice this flat line right here, lows, pierced it here, touched it here, right through here, and then look at this upsloping trend line. Exact low to exact low. Where do those two lines come together? Right there. What does price do? It bounces. All right, just a reminder. All right, when you have two lines that coexist together, meaning let's say they meet at some point and price comes into that price, and if it's oversold, the probabilities are extremely high for a bounce. Same thing, if it's overbought and you have two lines coming together and price hits it at that level, probabilities strongly favor a bounce or a pullback at those levels. Multiple lines converging, it's like one line is good, two lines is amazing, three lines is like, holy cow, stop the presses. That's the way TA works. All right, guys. All right. On that note, I just want to remind everyone, Verified Investing, my goal here and Verified Investing's goal is to fight for investors, even the playing field against institutions. That's why everything we do here is data-based, chart-based, technical analysis-based, no emotion, no nonsense, no hype. We want you guys to have the information, and the TA that we're giving out, the knowledge that we're giving out is honestly what institutions use to trade. All right. It is the stuff. In fact, we're going to be launching the scanner. So we have a scanner that finds for day trading, finds key pivotal points. That'll be launching to the public. We already have it launched for the live day trading room, but it's a scanner. It picks up the methodology that I teach. And again, that will be going out, I hope, on Monday, maybe next week. I shouldn't say Monday, but sooner than later. You guys should see that as an option to purchase if you're interested. All right. So on that note, guys, as always, thank you so much for being avid watchers of the game plan, supporters of us here at Verified Investing. I will talk to you soon. Take care. Have a great weekend.